I, He got fire from Cain, now we ain't got no shame. So we started a pod, Chuck Yates needs a job.
Hey everybody, welcome to Chuck Yates Needs a Job, the podcast. I'm with my partner in crime from BDE, Mark Meyer. Welcome in, Mark.
Thank you, Chuck.
All right, so you and I both got a copy of the Deloitte, I want to be specific, Oil and Gas M&A Outlook for 2023. You and I both got a copy of this report, and we've kind of dug through it, so we thought maybe we'd deep dive this. I got one pressing question, though, before we start. What the hell happened to Touche? Like when I grew up, it was Deloitte and Touche. What happened to Touche?
I can't keep up. Right.
Yeah.
I just can't keep up.
Well, how many are there now? 4?
There's KPMG,
Ernst
there's
& Young.
Deloitte, E&Y, and
Who's the other one? That's bad.
PwC.
There we go. PricewaterhouseCoopers. There we go. Got it. All right. Anyway, I'm just kidding. But I'm sure
There was an XTO, now there's a TXO.
That's true. That's true. There we go. All right, so they put out this M&A report, which I thought was really cool. I'm sure you can find it on the Deloitte website to dig through. And kind of the punchline to M&A in 2022 was, we arguably had record product prices during that, but we had extremely low volumes. We wound up having kind of a different mix of M&A type activities. And so what I thought I would do is just real quick, they say there are now new strategic drivers of M&A. So I'm going to list these off real quick, and then I'm going to let you take this wherever you want. But one, obviously, is energy security. Putin marching into Ukraine made that important. They said another strategic driver is operational excellence. We're worried about cash flow these days, so M&A is being used to consolidate, operate cheaper, et cetera. Energy transition is a big freaking deal. I'm sure we're going to spend a lot of time talking about just how much of the M&A dollars were energy transition stuff. There are a lot of partnerships going on in the energy transition, which is in effect kind of M&A, right? If you're doing a joint venture of some sort. And then this was kind of cool, and we've talked about, I want to say when you came and first hosted BDE with me, we even talked about this, that you would start buying properties to increase your ESG scores. And so they're seeing that. So that's kind of the framework. They got a lot of great data. This is kind of 35-ish pages. Mark, what say you?
Well, I think all those drivers are in kind of the new strategic framework. They all make sense. And exploring a little bit deeper, what's floated to really the top of the list, I think, is twofold. Really, the first two, energy security and operational excellence for the short to medium term, continuing to harvest efficiencies, having a security of within your portfolio and inventory, and then continuing to be able to both acquire scale and cost efficiencies, whether that's through, reduction of redundancy or through enhancement via technology. Energy transition, I think, is a bit of a friction point at the moment, and I think we're going to see that in the upcoming CERA week, given the conversation on both sides of traditional energy and the energy transition or renewables. But I do think companies are looking to acquire capability and knowledge and technology as opposed to develop it in a homegrown fashion in a lot of ways. We did see, and we talked about it a couple of weeks ago, we did see, I think, a record in renewable CapEx where it rivaled that in traditional energy of like 1.2 trillion.
Yeah.
And so, these companies are all going to have a path and a strategy that they're going to follow. Partnerships have long been part of oil and gas, whether they're drilling partnerships or joint ventures on new technology with strategic players. And then you're right, we did talk about early on, is there credit being given, or is there going to be accretion of your ESG score and ESG profile as a result of the targets that you take on and ultimately acquire. Are we now going to hear companies talk about this deal as accretive to both earnings, cash flow, and our ESG score?
I haven't seen that press release, but it feels like we're in range.
Right.
Yeah,
I mean,
it feels like so. Okay, so kind of to the energy security operational excellence bullet points, because I think this kind of crosses both of them. And this was surprising to me. I don't know what I would have answered like before I read this, but when I read this, so supposedly 82% of the M&A deals were for natural gas and natural gas infrastructure. And that just seems really high to me. But, again, energy security, what is energy security? It's in effect getting LNG into Europe, right? But I found it really interesting because if you look back at 2020, call it 30% of the deals were natural gas based, 70% were oil based, and we've, in effect more than flipped it. And then when you start looking at M&A activity within sort of this natural gas stuff, and they've got a chart here that excludes pipelines, I mean, there were 25, almost $30 billion worth of tankers, storage, trucking, LNG stuff acquired during that. So that surprised me.
I think part of it may have been a bit of a hurry up in early first half to through the third quarter of 2022, and the anticipation that things were going to be very tight in the kind of Western hemisphere with respect to being able to deal with winter. And so there's a lot of momentum behind LNG. Not saying that was a driver of all of it, but that was part of the dynamic, I have to believe. And so these are big ticket items in the LNG supply chain as well. So from a dollar value standpoint, it I think it makes sense. No one anticipated what ultimately happened with the weather helping the situation as much as it did. But I do think these are, longer cycle commitments that, as we've discussed before in other shows as well, that, looking out toward the end of the decade, LNG, we think is going to be a good place to be. And so this is positioning, and you got to put the capital to work with significant lead time to get, these supply chains buttoned up and operating.
Yeah, no, it's interesting because we've talked on BDE about how Shell's new CEO ran the natural gas business, and they're talking about natural gas now as kind of the future. We hear Toby Rice talk of LNG as well. And so, again, maybe it shouldn't have been surprising to me, but it just was that much was done.
Yeah, I think the surprise can be found in the larger backdrop, which is, the world we mostly live in. It's companies raising dividends, increasing buybacks, and returning cash to shareholders. In fact, I think 2022, at least as far as the upstream goes, was the first year in practically forever, where dividends, repurchases, and returning cash to shareholders in other forms exceeded capital investment in the business.
Yeah. So another point kind of, I guess, in those buckets is 28% of M&A activity was the Permian Basin. I think one thing that people forget about the Permian Basin is it's just huge, right? It's like 54 different counties. It's 1/3 of all the production in the U.S. So we go, oh, it's Permian focused. Well, it's 1/3 of all U.S. production. And look at that. It's 1/3 of M&A, But so there was a focus on M&A. It was the leader in M&A. The interesting thing, though, is not getting paid dollars per acre anymore, though. I mean, it showing on this chart, it looks like back in 2017, you were getting paid almost $55,000 per acre in the Permian. And looking today, it's like just over 10, which is kind of what we've seen.
Yeah, I think the lower volume of deals, the kind of the low point in market cap traded down from a peak in the sector, not just Permian, but I think 10% of market cap changed hands in the recent peak, and now in 2022 we saw that drop to a low of 3%. And so the notion that you're buying something speculative or to be developed to add to your inventory when the demand has been high and is getting higher for cash flow and return of cash. I think the notion that you're paying premium prices for acreage when you have a stated inventory life that is a reasonable number of years is going to take some of the pressure off, the upward pressure off of at least the metric that we came to know and love in the early part of the shale frenzy was how much are we paying for undeveloped acreage in this transaction. So most of what we've seen recently comes with a pretty healthy bit of current production as well. Yeah.
And part of me, this is circular and selection bias, right? Is, well, if I'm not going to get $55,000 per acre, why do I sell it? So to me, it makes a lot of sense. I mean, I know from the buying point of view, if everything's 3 times EBITDA, then I want to buy everything I can. But the flip side, if I'm the seller, I don't want to sell. And if I don't have a balance sheet reason for why I have to sell, if I don't have a better use of proceeds, that to me kind of makes a lot of sense.
Right. And I think that is driving, seller behavior to a large extent is exactly that. An unacceptably low valuation from a cash flow standpoint, making at least the perception of equity currency or using equity to finance deals very expensive, right? So there's a gap between buyers and sellers in that regard, and when you combine the fact that debt financing is certainly now much more expensive, and shareholders do not want to see leverage ratios increase. In fact, just a few years ago, when we were just starting into this difficult period that started with OPEC's November surprise in 2014.
Normally, it's the Dallas Cowboys losing on Thanksgiving Day that shits all over my turkey day. But that year it was OPEC.
Yeah. So the prevailing wisdom around that time was you needed to kind of get south of 2.5 debt to EBITDA, 2.5 times debt to EBITDA. I see a lot of, well, we think we can get under 1 and head towards 0.5, big difference. And so the combination of more expensive debt financing and the push for lower leverage ratios has really kept debt kind of out of the mix of major financing considerations.
Because I think the only time we've seen cash on a deal here in the last, I don't know, 2 or 3 years is Matador buying that EnCap company.
No, that's right.
That was a big check, but outside of that, and it seems like that was long enough ago that they did it under the window of lower interest rates. But still, I don't think we've seen that. So, kind of another interesting thing, in this report that we saw, $32 billion of clean energy M&A by oil and gas companies. And when I'm looking at this chart, you saw, a couple of years that may have had $10 billion of clean energy stuff, but most of them were less than 5. And then boom, $32 billion. And I guess what they're defining that is, call it renewables, solar, wind, carbon capture, biofuel, hydrogen, ammonia. So that's kind of crazy. You and I have talked about this on BDE. I still don't understand why the core competency of an oil and gas company means it should go put in a wind farm. But
well, it'd be interesting to see the breakdown of CCUS, for example, or carbon capture more broadly versus wind and solar. We know BP has made big commitments with current capital in terms of securing offshore wind leases. They're committing, I think, pound for pound, way more of their capital budget to actual direct investments in renewables. And, how that breaks down across the different players, whether it's international players, European players, US-based players, it's not all that surprising because the commitments to get renewables or your energy transition, part of your portfolio off the ground, is going to require, some accelerated commitment in the form of capital. And I think boards and shareholders have been demanding that, at least under some of the ESG mandates and the activist mandates.
And I'm eyeballing this graph and my eyes are shot, right? Because I'm old, but it looks like carbon capture and wind and solar are about equal. It looks like it's, call it 12, 13, 14 billion each, something like that, which, and if you look back at, let's go back pre-pandemic. I mean, I can't even see in 2019 any carbon capture CapEx spent on this graph.
Well,
which is crazy.
That's the easiest one to get comfortable with for a traditional oil and gas company, right? It's about putting gas in the ground.
We take it out, we put it back
right.
in.
We've done
it's a
it
reservoir.
We've done it for decades. We put CO2 in the ground, we've put air in the ground, we've put
water
and we've put polymers. We're good at taking fluid media and injecting it back into the reservoir. So it's really the same concept.
Yeah.
And a lot of, technical know-how, there's a risk calculus around all that says we're comfortable scaling these things. I think the one that's currently leading the way is obviously Oxy. And then Exxon has, talked of upwards of $100 billion invested over time in Gulf Coast carbon capture, utilization, and storage.
So I'm going to kind of get on the soapbox here, but we said earlier, 70% of the deals involve buying somebody with a better ESG profile, which makes a lot of sense. I went and looked this up, though. It's not like the fields that were polluting went away. They're just owned by private companies these days. So when you look at kind of the top emitters of methane in the United States, number one's Hillcorp, right? Large private company. Exxon's number two, but then you have Terra Energy, Flywheel, Blackbeard, all private companies that are. And so I think what you've done is you've just bought a nice field, sold an emitter. I don't think the world climate has changed any.
Well, in an absolute sense, that should be the conversation, right? What have we done from an absolute methane and CO2 emission standpoint? If we're moving things around on the game board, and this conversation cropped up when the first kind of board level activism was coming up, and shareholders or their representatives were demanding that oil and gas companies emit less, reduce their traditional production. That doesn't mean global demand's going away and somebody's going to fill it, and probably someone with a much lesser ESG and emissions profile, meaning offshore. And I'll make another plug for Mike Umbro, who is fighting the good fight seemingly on his own out in California. He talks a lot about the pressure to shut down production in California, which has long been a major oil and gas province in the U.S. And what that results in is it favors barrels, particularly from Ecuador, as he talks about, that certainly because of their impact on the Amazon rainforest and operations down there, and the ESG profile is not a good trade relative to much higher standard U.S. operations. And we've also heard others voice pretty strong support for doing more with regard to getting Canadian barrels a better profile. They have a good ESG profile on a relative basis. Why don't we do more there to source more from Canada? But again, this whole kind of moving the pieces around on the game board is a relative conversation. What's the overall impact on absolute emissions by doing those things without demand moderation? Because someone is going to fill that demand gap.
Yeah.
And it's likely been someone with a much lesser ESG profile.
When you and I did the energy policy draft and we had the folks on, everybody was drafting. I mean, that was Sankey's point. Sankey's, I think, was the only. We all talked about supply, basically. Sure. Everybody else, but Sankey went after demand and said, "You just in the United States, you got to raise the tax on it and talk about a sliding scale or whatever." before we kind of close to talk about the why, I love this page. This is page 7 of the Deloitte report, and they in effect gave a scorecard on how M&A is done. So I'm just going to read some stats to you. 6 out of the 10 deals done. So out of the top 54 corporate deals since 2005, 33 have delivered relatively lower EBITDA. When you look at on a value basis, so stock returns, 6 out of 10 underperformed. So the same deal, out of those 54 top corporate deals, 34 have delivered subpar shareholder returns. They talk about 50% underperformance in market share, and I'm not exactly sure how they define that, but or what they meant by that. But the winner's curse, right?
Right. M&A is tough, and I think a big chunk of the M&A base against which this performance is measured is exactly as you said, the winner's curse. We saw a lot of really rich valuations, in some cases implied by that simple metric of dollars per acre, right? And then you get hit with, post the close of the acquisition, you get hit with an unfortunate collapse in prices where the NPV calculus says you need to put a lot more rigs to work to bring the NPV forward. It's great to have several decades of inventory, but the present value erosion begins immediately unless you can actually exploit that and turn it into cash flowing assets.
There's not a board of directors on the planet that would, nor should, put in a bunch of oil hedges because you just bought a lot of acreage. You just can't do that, And so $50,000 an acre, $75,000 an acre, whatever it is, embedded in your willingness to pay that is an oil price that you can execute on.
Right.
And you buy production, sure, you can go lock in 3 years, 5 years of hedges, whatever you want to do. But it's tough to do it when you're like, we got to drill this, right? It's got to come out of the ground.
I'd like to see a comparison of the kind of the market metrics of underperformance or outperformance relative to other industries in looking at the overall M&A outcome, post M&A outcome. My sense is that underperformance is perhaps more the rule than the exception. But
across all industries?
Across all industries.
Okay, yeah. Yeah, no, I mean, because, if you really think about it, if something is truly worth a normal distribution of what everybody thinks it's worth, and that's not a bad assumption to have. I mean, the winner by definition is the person that values it more than anyone else on the planet.
Well, we've also changed objectives coming from the institutional investor side. I witnessed in the early part of the shale sweepstakes, both in gas and more recently and more particularly in oil and even more particularly so in the Permian part of it, it for a long time was, going from a mere 20 years of inventory to 50 and talking about, in one case, I won't mention the name, having over 70,000 prospective future locations in inventory. You put any reasonable kind of rig schedule and organizational capacity behind the calculus of how long it would take. And I've said calculus a lot today, so that must be the word of the day.
You studied your SAT words this morning.
The point at which you get all of that inventory ultimately drilled, produced, and depleted and the cash flow harvested is, decades upon decades out in the future. And so having that inventory, having paid a current price of $45,000, $50,000 an acre, but not drilling it until 30 years later, that's a tough equation.
Yeah. And I think you're hitting the nail on the head. And I think this is where we kind of ought to go. Cause just to punchline, what the report showed, and this is a good report. Everybody should download this and read it. You had record low volume. You did have record high prices during the thing. Strategic objectives are different than they have been in the past. And so I think you're hitting the nail on the head of, well, why? why is all that? And I go to Charlie Munger whenever I think of that. Show me a man's incentives, and I'll show you his behavior. Paying $50,000 an acre, having 70,000 locations and all. Guess what? That got me a 12 times EBITDA multiple out on the market. So guess what you're going to get out of me? You're going to get more acreage. You're going to get more locations. You're going to get more EBITDA. And today, they aren't trading at 3 times EBITDA. They're trading at a little more than that. But at those type, there's no incentive to generate more EBITDA.
I'll toss one more in, which is a famous Bob Simpson utterance, growing for sport, right?
Yeah.
There's no more of that. I think the overarching set of incentives can be defined by current investor demands and what's been prevailing over the last few quarters and a couple of years. And so companies are behaving rationally relative to those incentives that are being placed before them. And it's consistent. The lower numbers, the lower value, the lower kind of cash financed or debt financed aspect of all this makes sense, because anything that's left over from operating cash flow gets returned to shareholders. That's what's gotten you paid as a management team. That's what has driven stock outperformance, the better of those performers. And so until there's a major shift that comes along that changes the incentives, and I don't see anything on the near horizon, more of the same continues, which I think on an underlying basis does nothing but tighten the macro and make fundamentals more attractive.
So I was talking to the CFO of one of the multi-billion-dollar oil and gas companies. I go, "Hey man, what's going on?" He goes, "Man, I send out dividends and nobody bitches at me. That's a lot easier than run a bunch of rigs." So I want to take it one step further, because I think you're right. I mean, all of this report can be explained by how you're valued out there, whether it's Wall Street or whether M&A, how you're valued. I agree with that. I want to go one step further. Why? And I'm willing to go first on this, and you can agree or you can call me an idiot. But I truly believe the political environment of we're destroying the planet, we're getting rid of energy, we're going to stop it. All of that rhetoric has created a real, what I'll call a tail fear in investors. It's like, hey, I need to get all my money back and call it 3 years and then get a return, because I'm not sure you're going to be here in 7 or 8 years. So I don't want you building value in 7 or 8 years. I don't want you buying a location that we're going to drill in 10 years. So I truly think it's the political environment. Now, I'm a libertarian, so I'm kind of bashing both sides on that. But anyway, agree, disagree, what say you?
Well, I mean, the valuation plane is kind of stalled here at 3 to 4 times elevation level, if you will, right? And so rationally, am I willing to look out and pay more for cash flows beyond that time horizon? It lines up with what you said. I think it, in my opinion, would be it has more to do with investors having suffered through a decade plus of literally zero return on capital, right?
Yeah.
And so I've got to put points on the board over not just 1 or 2 quarters, but maybe a handful of years, right? And what happens if Goldman and others who have been saying, we've still got $100 oil in the cards by the end of the year, is that far enough from the bad past of returns to then say it's okay, we're gonna allow you to start spending more and kind of leg into this growth that's provided by an elevated commodity opportunity that historically has never ended well, because it's always overshot, and usually from the supply side, unless there's something more global at work here. In terms of the demand side, we've shown that we can kind of wreck the party from the supply side.
And you brought up a thought for me that I think is fair too. Investors have been disappointed. Quite frankly, the tales that they have seen in reserve reports and investor presentations have been wrong. And a lot of that was drilling shale wells were new. So we got B factors wrong. And I truly believe a lot of this was honest mistakes. I mean, Spacing was a nightmare. What I will tell you is in 2019, and I'm going to kind of make up these numbers-ish, one to protect confidentiality, but, hell, it was 4 years ago, so it doesn't matter that much. We spent almost $1 billion drilling wells, and we were at the spacing type point of, we had drilled our initial wells. We knew where our rock was. Is it 8 wells per section? Is it 6? Whatever. So we were doing that. If you looked at the year-end 2019 reserve report, and the $1 billion we spent was all drilling. That's not acreage. It's all drilling, and it's all basically spacing drilling. If you looked at the end of the year reserve reports, and we had enough production history that this was probably a decent stab, we drilled, call it 35% rate of return wells, which normally you go, okay, that's great.
Wellhead
return. So D&C cost, versus that. But unfortunately, just given the price we had paid for acreage, we probably needed to drill about 45 or 50% rate of return to really make the whole endeavor economic. And my point,
economic defined as covering your cost of capital plus.
Yeah, let's call it making a 20% rate of return on equity or something. And my whole point of bringing this up is, I think we were as good as anybody on the planet. Mike Hines is an amazing reservoir engineer. We had amazing management teams. The guys at Kraken are unbelievable, et cetera. It was just really hard to figure out spacing. And if you had an ounce of cynicism in you and you were an investor, guess what? You looked at the management teams and said, you said it was 8 wells per section. Should have only been 6. You lied to me. So I could take it that far and see that as part of the problem.
We could do a whole show on this. Everybody's had that experience where they either over-drilled or overstimulated a multi-well pad. I often said that this is the world's most complex 3-dimensional dynamic math problem to solve. And fortunately, what we're seeing in terms of things like analytics and just sheer data capacity and processing and predictive methods, you can now integrate a lot of what was primarily leaned on was what I'll call numerical simulation without a lot of accommodation for the important, unique physical data that a certain section, for example, that you may have, 24 wells across 3 benches, and then how am I going to stimulate that? At what frequency, at what both lateral and vertical spacing? And then what does kind of the interwell or interlateral dynamic look like when I'm in the midst of the stimulation program? Can I adjust for all of the things that, influence the variability of outcomes? And I think being able to do that in a modeling exercise before you actually put a bit and steel in the ground is kind of the nirvana here. We're still doing most of this by, brute force trial and error. And when you do that on a 24 well pad, all of a sudden you look back and you've spent $200 million all in.
Right.
That's not a small incremental thing. That is equivalent to what we think of in the old days as big projects. Okay. And you can sink a lot of capital in a very short period of time. I used to say that, the great thing about unconventional is, the resources there. The bad thing is you don't know that you've drilled a commercial dry hole until many reps in, usually, right?
Well,
so,
what was interesting is we did a lot of early stage assets back in my career where we drill the first horizontal well in a county, et cetera, first time using fine mesh sands on a frac, whatever the case may be. And what was interesting about the mindset is when you drilled that first well, you wanted to spend every dollar you needed to so that you could really figure out what the rock was going to do, and then you could optimize later. And that was the mindset, because you'd have a management team that would, we only need to do 75% of this frac. And you're like, no, do 100% of the frac because we need to know what the rock does. When you go to spacing, it's 180 degrees. If we think it's 8, we need to do 4 wells and see. And then on the next one, we'll add the 5th, because what we found in certain spots was you think it's a milkshake, right? And if you put too many straws in it, okay, I spent too much money. We found in certain places that if you put too many straws in the milkshake, you didn't get all the milkshake out.
Right.
And I'm sure that was friction driven or whatever. But anyway, so one, you had to shift mind frame, and then two, it was a lot harder than anyone said.
And tying it back to what we're talking about, I do think that the learnings from all of this over the past few years, since the re-engagement post 2015, 2016 is just that. We've learned a lot more on spacing, completion with very sophisticated things like fiber optic monitoring during completions. And then we have some runtime with well performance between parent and child wells, for example. And so the industry is very good at adapting to what it's learned and applying that. And so I think we're seeing a more deliberate, forget about all the capital restraints, which I think certainly amplifies the slower pace, but I think we're seeing a much more deliberate, let's really apply the science that we've learned here to getting this problem right. And the tools that we've got have literally come leaps and bounds forward from a technology and a simulation, training data sets, a prediction capability, and the ability, like I talked about before, to really put a lot of robust, unique data into the predictive tools and the analytical tools is just making for ultimately better outcomes in the future.
Yeah.
Which in some cases, if I look back and I paid $45,000 an acre, and in hindsight, I didn't get but 2/3 of the well spacing that I thought, and just keep it simple, maybe 2/3 of the recovery potential, that that's going to give me some pause as I look forward and try to figure out what it is I'm buying, what is I'm drilling, and on what spacing and under what completion design.
Yeah. Okay, let's close it here because this has been interesting, and this was cool to read through. Let's close it here. I'm going to pick 2 years. No, I'm going to pick 3 years. 3 years. We're going to come back. We're going to do this same exact podcast. We're going to have the Deloitte report right in front of us. What does it say? 3 years from now, what are 2 or 3 things in there? I'm asking you to look in your crystal ball.
3 years out, I think we're back to a bit more of a normal run rate of traditional oil and gas M&A. I think there's going to be inventory questions that pop up. I think the fundamentals will be reasonably supportive. I mean, I just saw something over the weekend that talked a little bit about China demand, but overall we're heading towards 102 million barrels a day, and raises the level of conversation around peak demand. And I think the horizon over which companies will be incented to invest will motivate more activity relative to today, and I think that's what we're going to see. And they're going to give some time for these joint ventures and renewables and transition related investments to incubate, because the attention about returns and capital efficiency, I think, is going to remain very high. So they've got to find that equilibrium balancing act, but I think they're going to have to address their core businesses and the portfolios through more activity. That's really the subject matter of this report and this outlook for 2023.
Gotcha. So my prediction is U.S. M&A activity will continue to decline, and it'll be status quo. We're just sending out dividends. If we see and we will also see a lessening of the energy transition type M&A, because I feel like people have bought their stuff, and there is going to be a little bit of a weakening of the pressure to do that. If we see an uptick in M&A, it's to the point we kind of started this with. It's going to be international. It's going to be guys figuring, I got to go get the barrels out of Ecuador. I got to go here or there. Because I'm still, and I don't want to be this way, I'm still really pessimistic that we, the energy business, are going to be able to make a case to the world of, hey, you need more of us. It needs to happen here in the United States and Canada, where we do it the right way. So,
I mean, it's going to be a tough path to trail to blaze, so to speak. And it sounds weird to use the concept of a trailblazer in an industry that's 150 plus years old and has really driven the miracle of the global industrial revolution that we've witnessed. But I think there's a lot of elements to think about how you kind of tiptoe forward in the future and do what you're really good at and make sure that you have sufficient portfolio inventory to continue to execute. Right. So that's why I think we're going to see a higher point 3 years down the road than what's indicated by the stats that we're looking at here.
We got it on tape, so we'll be able to refer to it. Mark, thanks for coming on.
Thanks for having me.